Starting January 1st, 2026, a rule inside Secure 2.0 kicked in that just locked high earners out of a tax break they've had for decades. If you earned more than $150,000 in FICA wages from your employer in 2025, you can no longer make pre-tax catch-up contributions to your 401k. Every dollar of catch-up money now goes in after tax as Roth. This isn't a phase-out. This isn't a gradual change. This is a cliff. $149,999 in FICA wages, and you keep the pre-tax option, $150,001, and it's gone forever. Every year you're over that line. And almost nobody saw it coming because the financial media buried it under headlines about contribution limit increases. The tax bill is real, the math is brutal. And when you see how this stacks with every other penalty the tax code throws at upper middle class earners, you'll understand why the system is designed to claw back wealth from the people who can least afford to lose it. My name is Alex, and I've spent the last 15 years analyzing tax policy and retirement law so you don't have to. I read IRS notices and Treasury regulations the way normal people read novels. And what I found in SECR 2.0 Section 603 made me realize that high earners just became the target of a permanent stealth tax increase that will cost some of you thousands of dollars every single year for the rest of your working life. If you want to protect your retirement savings and understand what just changed, make sure to hit that subscribe button and give this video a thumbs up if it helps you keep more of your own money. Before we dive in, I'm curious. Do you currently max out your 401k contributions, or are you still working your way up to that? Let me know in the comments because I want to understand where this audience is in their retirement planning journey. Here's what you need to understand. This isn't a loophole closing. This isn't tax reform. This is the government forcing you into a specific tax decision that benefits them now at your expense later. And they're doing it to the exact income bracket that has the least amount of lobbying power to fight back. The ultra-wealthy don't care because they don't earn W-2 wages. The truly poor aren't affected because they're not hitting $150,000. This hits the doctor, the engineer, the dual-income household, the person who worked their way up and finally started making good money. You. And the reason it works is because it sounds reasonable on paper until you actually do the math on what it costs you. The trap isn't the rule itself. The trap is that most people won't realize they're caught in it until tax filing season 2027, when their accountant tells them they owe an extra $2,000 because their catch-up contributions were forced into Roth. By then, it's too late. The money's already been taxed, the decision's already been made for you, and you're locked into this system every single year you earn over $150,000 for the rest of your career. What nobody's explaining is how this rule interacts with everything else the tax code already does to high earners. IRMAA surcharges on Medicare, net investment income tax, AMT, phase-outs on deductions. Each one alone is manageable. Stacked together, they create a system where earning more money past certain thresholds actually costs you more per dollar than it did at lower income levels. The marginal tax rate they show you on the bracket chart is a lie. Your real marginal rate when you factor in all these clawbacks can hit 40, 50, even 60% in certain scenarios. And now this. Another piece on the pile. Another $1,000 or $2,000 the government decided you should pay this year instead of deferring it to retirement when your income and your tax bracket will almost certainly be lower. But here's the thing, nobody wants to say out loud. For some of you, this might actually be better. Not because the government's doing you a favor, but because the math on Roth versus traditional depends entirely on your future tax rate. If you genuinely expect to be in a higher tax bracket in retirement than you are now, paying tax today locks in a lower rate. If tax rates across the board go up in 20 or 30 years because the deficit finally forces Congress to raise revenue, Roth wins. The problem is, that's not the situation for most high earners. Most people making $150,000 or more today are not going to be making $150,000 or more in retirement. They're going to downshift. They're going to draw down. Their income is going to drop, which means their tax bracket is going to drop, which means paying tax now at 24 or 32% to avoid paying it later at 12 or 22% is a bad trade. And the government just forced you into that bad trade whether you wanted it or not. Now we get to the part that actually matters. Everything before this was just context. What I'm about to show you is the mechanics of how this rule works, the exact math on what it costs you, and the few strategies you have left to minimize the damage. Because this rule isn't going away, it's permanent. And understanding it now is the difference between losing $2,000 a year for the next 15 years or adjusting your strategy to claw some of that back. The threshold is based on FICA wages, box 3 of your W-2, not your total income, not your adjusted gross income, not your salary from multiple jobs combined. Your FICA wages from the specific employer sponsoring the plan you're contributing to. This distinction matters because if you switch jobs mid-year, your FICA wages from your new employer in 2025 might be zero, even if your total income for the year was $300,000. In that scenario, you would not be subject to the Roth catch-up mandate in 2026. You'd still have the pre-tax option. But the following year, assuming you stay at that job and earn over $150,000, you're locked in. The rule applies every single year your prior year FICA wages from that employer exceed the threshold. And the threshold is indexed to inflation going forward, so it will slowly rise, but not fast enough to keep pace with wage growth for most high earners. The 2026 contribution limits. Base 401k deferral is $24,500, up from $23,500 in 2025. That base limit is completely unaffected by this rule. You can still split that $24,500 however you want between pre-tax and Roth. The catch-up contribution for people age 50 to 59 and 64 plus is $8,000, up from $7,500. The super catch-up for ages 60 to 63 is $11,250. Total maximum contribution for most people over 50 is $32,500. For the 60 to 63 sweet spot, it's $35,750. Only the catch-up portion, that $8,000 or $11,250, is forced into Roth if you're a high earner. Everything else is still your choice. Here's the gotcha that's going to blindside a lot of people. If your employer's 401k plan does not offer a Roth option, and you're a high earner subject to this rule, you cannot make catch-up contributions at all. You don't get a pre-tax fallback. You're simply locked out. The IRS doesn't care that your plan isn't equipped. The rule applies regardless. So if your HR department hasn't added a Roth feature to your plan yet, you need to ask them about it now. Because if they don't have it by the time you're eligible for catch-up contributions and you're over the income threshold, you just lost $8,000 or more of contribution space you can never get back. Let's do the tax math because this is where it gets real. $8,000 in catch-up contributions at the 24% federal bracket is $1,920 in tax you're paying now that you previously would have deferred. At the 32% bracket, which kicks in at $197,300 for single filers in 2026, that's $2,560. And that's just federal. Add state income tax if you're in California, New York, New Jersey, and you're looking at another $500 to $800 depending on your state bracket. We're talking real money, $2,000 to $3,000 in additional tax liability per year that you used to be able to defer for 20 or 30 years. Compounded over a 15 or 20-year career at this income level, that's $30,000 to $60,000 in lost deferral value. Money that could have been growing tax deferred, now taxed immediately and growing in Roth where you can't touch it without penalty until 59 and a half. If you've made it this far, you're already ahead of 90% of people who have no idea this rule even exists. But don't stop now, because the next part is where I show you the strategies that actually work to minimize the damage, and one of them is hiding in plain sight. This rule is permanent. It doesn't sunset. It's not part of a temporary provision like some of the other tax changes we've seen in recent years. Once you cross $150,000 in FICA wages, your catch-up contributions are Roth only going forward. Every year. Unless your income drops back below the threshold, which for most high earners in their peak earning years isn't happening, you're in this system now. The question is what you do about it. The cliff effect is brutal. Earn $149,999 in FICA wages and you keep full control over your catch-up contributions. Earn $150,001 and it's gone. There's no phase out, no gradual reduction. It's binary. And because it's based on prior year wages, you won't even know you're subject to it until you're already in the following year and trying to make contributions. By then, your 2025 W-2 is done, the number is locked, and if you're over $150,000, your options just disappeared. This stacks with every other penalty the tax code throws at high earners. IRMAA surcharges on Medicare premiums start at $106,000 for single filers, $212,000 for joint filers in 2026. That's an extra $800 to $6,000 a year in Medicare costs depending on your income bracket. Net investment income tax is 3.8% on investment income above 200,000 single, 250,000 joint. AMT still catches people in the 150 to 500,000 range. Itemized deduction phase outs, child tax credit phase outs, student loan interest deduction phase outs. The tax code has built an entire architecture designed to punish the upper middle class from multiple angles simultaneously. You make too much to qualify for help, but not enough to restructure your income through trusts and capital gains like the truly wealthy do. You're stuck in the squeeze. And every year Congress adds another tool to tighten it. Here's the counterargument, and I'm going to be honest with you because that's what this channel is about. Roth accounts have massive advantages. Tax-free growth forever. No required minimum distributions as of 2024. If you genuinely believe you'll be in a higher tax bracket in retirement, or if you believe tax rates across the board are going up in the next 20 to 30 years, paying the tax now locks in today's rate. 24% today beats 35% in 2040 if that's where rates go. And there's a real argument that given the federal deficit, given unfunded liabilities in Social Security and Medicare, given the political impossibility of cutting spending, tax rates probably are going higher, not tomorrow. But over the next couple decades, it's plausible. If that happens, being forced into Roth now might actually save you money later. That's the honest case for why this isn't all bad. But here's when it genuinely hurts. If your tax bracket in retirement will be lower than it is now, which is the case for most high earners who plan to downshift and live off savings rather than continue earning, you're paying more total tax by being forced into Roth. You're paying 32% now to avoid paying 22% later. That's a bad trade. And the government just made that trade for you. You don't get to opt out. You don't get to decide based on your personal situation. The IRS decided for you based on a single number, your FICA wages, with no regard for your actual financial plan. The 2026 transition year has some flexibility. The IRS final regulations technically apply starting January 1st, 2027, but plans must operate in reasonable good faith compliance starting January 1st, 2026. In practice, that means some plans are still figuring out their systems, some record keepers are still updating their platforms, and the IRS has signaled it will be lenient for honest errors during this transition period. If your employer messes up the implementation and you accidentally make pre-tax catch-up contributions in 2026 when you should have been Roth, it's correctable. The IRS isn't going to penalize you for your plan administrator's mistake, but that grace period won't last forever. By 2027, the expectation is full compliance. So if your plan isn't ready, now is the time to push HR to get it fixed. Now let me tie all of this together because when you see how these pieces connect, everything changes. You have 5 moves you can make right now to adapt to this rule and minimize the damage it does to your long-term wealth. These aren't loopholes. These aren't tricks. These are adjustments to your strategy that take the new reality into account and turn a forced decision into an opportunity. Move 1. Max out your $24,500 base contribution first and keep it pre-tax if that's what your financial plan calls for. That base limit is completely unaffected by the high earner rule. You still have full control over it. If your goal is tax deferral, put every dollar you can into that base limit before you even think about catch-up contributions. That's $24,500 of space you control. Use it. Move 2. Reframe the forced Roth catch-up as a backdoor opportunity. High earners are phased out of direct Roth IRA contributions. In 2026, the income phase-out starts at $153,000 for single filers, $242,000 for joint filers. If you're making $150,000 plus, you probably can't contribute to a Roth IRA directly. But now you have a guaranteed Roth vehicle through your 401k catch-up. $8,000 or $11,250 a year going into Roth with no income limit, no phase-out, no backdoor conversion games. That's actually valuable. You're being forced to build a tax-free bucket that will never have required minimum distributions and will grow completely tax-free for the rest of your life. If you can afford the tax hit now, that's not a bad position to be in. Move 3. If your plan allows after-tax contributions, look into the mega backdoor Roth strategy. The total contribution limit for employer and employee combined in 2026 is $72,000. If you're maxing your base $24,500 and your employer is kicking in a match, you might still have room to make after-tax contributions beyond the pre-tax and Roth limits, then convert those after-tax contributions to Roth. Not every plan allows this, but if yours does, it's one of the most powerful wealth-building tools available to high earners. You're essentially shoveling tens of thousands of additional dollars into Roth accounts every year on top of your standard contributions. Move 4. Max out your HSA if you're on a high-deductible health plan. $4,400 for self-only coverage, $8,750 for family coverage in 2026. HSA contributions are pre-tax going in, they grow tax-free, and they come out tax-free for qualified medical expenses. And here's the secret. You don't have to spend the money on medical expenses today. You can invest it, let it grow for 30 years, and use it in retirement when your medical costs are highest. It's essentially a stealth retirement account with better tax treatment than a traditional IRA. If you're a high earner looking for more pre-tax space, HSA is your answer. Move 5. Adjust your W-4 withholding now to account for the higher tax bill from forced Roth catch-up contributions. If you're used to making $8,000 in pre-tax catch-ups and suddenly that $8,000 is Roth, you just lost the tax deferral on that money. Your paycheck withholding might not adjust automatically. You could end up owing at filing time if you don't increase your withholding now to cover the additional tax. Run the numbers. Figure out how much extra tax you're paying because of the Roth catch-ups. Increase your withholding by that amount spread across the year. Do not let this blindside you in April 2027 when you file your 2026 return and owe an extra $2,000 you weren't expecting. The visual here is simple. Imagine climbing a ladder. Every rung you climb represents more income, and every rung above $150,000 has a hidden trapdoor. IRMAA. NIAT. Catch-up Roth mandate. Phase-outs on credits and deductions. The system is designed to claw back benefits from you the higher you climb, but only up to a point. Once you get rich enough to earn from capital gains, from trusts, from business income instead of W-2 wages, the trapdoors disappear. The truly wealthy aren't subject to IRMAA because they don't take Medicare. They're not subject to FICA because they don't earn wages. They're not subject to catch-up Roth rules because they don't have 401ks. This entire architecture punishes the upper middle class. The people who worked hard, climb the ladder, and make good money but not enough money to escape the system. That's you. And understanding that is the first step to navigating it. Here's what this means for your future. You're not powerless. You're not stuck. But you are operating in a system that just changed the rules on you without asking. The choice you have is whether you adapt or whether you ignore it and pay the price later. Adaptation means maxing your pre-tax-based contributions, using the Roth catch-up strategically, exploring mega backdoor Roth if available, maxing your HSA, and adjusting your withholding so you're not surprised at tax time. Ignoring it means you keep contributing the way you always have. The tax bill shows up, and you lose $2,000 or $3,000 a year you didn't have to lose. 10 years from now, the person who adapted will have a diversified tax strategy with pre-tax accounts for income in low bracket years, Roth accounts for tax-free income in high bracket years, and HSA money for medical expenses. The person who ignored it will have paid $30,000 more in taxes than they needed to, and will still be wondering why building wealth feels so hard. What financial topic is affecting your life right now that you can't find a straight answer on? Retirement accounts, taxes, real estate, investing strategy? Let me know in the comments. That's what this channel is for. Breaking down the systems that are designed to be confusing so you can make better decisions with your money. Your future self is counting on you to pay attention to changes like this. The government isn't going to send you a letter. Your employer probably won't explain it. Your financial advisor might not even know about it yet. You have to stay informed. You have to adapt. And you have to understand that the rules are always changing, and they almost never change in your favor unless you know how to use them. That's the game. Now you know how to play it.